Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. As always, this isn't individual investing advice. It is just my opinion, and I share how I analyze these stocks using the strategies that I've developed myself. Today we have RTX. It's part of a merger between, Raytheon, I think, and United Technologies back in the day. Let's first look at the cyclicality, since that's usually what I do. This one is going to hopefully be a relatively short video, but I do have a little bit of a mini lecture I'll give. So we don't have a lot of earnings cyclicality historically. Long term, they have pretty good growth, but you can see that starting around this time period, like 2015 or so, earnings growth starts to slow. And so we want to look at earnings, but we want to look at a more modern area. We don't have to worry. So we can use earnings, but we have to take into account downturns and things like that. So when we shorten the graph from 2015 through today, we can see that really there hasn't been much earnings growth. And then they definitely took a hit during COVID, which is forgivable because that's not really anything that they caused. But they really haven't recovered from there. I mean, even this year, the year's not over yet. If this comes in just a little bit, they'll be just now getting back in adjusted earnings to where they were. If we look at basic earnings, since they've had some M&A, we can see that they've been much worse. This year in particular is interesting to look at. You can see the basic earnings, the stock price is tracking the basic earnings better. I know they had some issues with some quality issues on some of their, I think they were engines. I didn't look into it deeply because it's not too important really. I'm not going to be buying them anyway. But the main thing I want to point out here is that earnings growth is pretty flat, okay? And if you look at the valuation, it doesn't look super expensive on the surface at 14 or about 15 PE. But when you don't have any growth or very much growth, you should trade at a lower PE. So here are the numbers that I have for them. I updated these, looks like last month. There's only 1 penny difference from the earnings expectations then and now. So these are all pretty much the same. When I calculated earnings growth and I took into account the drawdowns, the buybacks, and all that stuff, from 2015 through today, I only got an earnings growth of about 2% a year. Well, we've had more than 2% inflation a year, I would say, since then. How many is that? 8 years, so 16%. And then we probably had 20% inflation at least. So really, they don't have earnings growth that's keeping up with inflation. If this was just flat, let's say they are growing earnings at exactly what inflation is, or we expect them to, I would consider that like a no growth company. For me, no growth companies should be returning all their money to shareholders because they aren't growing. So I usually want to see a dividend of about 8%. If they're only growing at the rate of inflation, at least 7%. I mean, you need to be kind of in the ballpark, and that would be a kind of insurance policy in case earnings growth goes negative. Because when it's slow, the next step often is it goes negative growth. And usually when that happens, stocks sell off a lot and investors lose a lot of money. And it can be drug out over years. So in some ways, these are they're kind of sneaky dangerous because you can do something like buy them here, right? 5 years ago. And because they're not growing, it might not go drop 50% in a year, but you look 5 years later and you're basically flat, you're getting less than 1% return a year, and you've been holding this stock this whole time when the S&P 500 is like doubled during this time or something like that. So these can be really kind of sneaky bad stocks for investors generally to be buying. Now, if you consider this a turnaround, and you expect that in the future that something's going to change and that's going to make them have better earnings growth than they have now, that is the mentality I think you would have to justify buying the stock. I've gotten to the point where I don't purposefully invest in turnovers. I mean, sometimes I buy them and they deteriorate and they turn into turnovers on accident. So that's not something that I do. But if a person, there can be times when a turnaround, I was calling turnovers, a turnaround stock is works. It can happen, but it's pretty hard. With big companies, it's often rare, and so I just don't mess with them. Now, my threshold nowadays is I want this earnings growth, once I control for buybacks and downturns and all that stuff, to be above 4% minimum. That gives you a little bit of a wiggle room. So if they're growing 4% and maybe they have like a 5 or 6% dividend, you're getting a little bit of insurance back in case things never go anywhere or they kind of deteriorate a little bit. So at least you don't lose too much money. If you wait 5 years, you're going to get, if you're getting a 5 or 6% dividend, you're getting 25 or 30% at least return to you. So you're getting some of your investment back. If it gets hurt a little bit, you might not get killed. Usually this type of company doesn't have they usually don't have earnings fall 50% or something quickly. So usually this is the type of thing where it can be like a slow decline or a grind sideways, which is exactly what we've seen, until some kind of catalyst comes along one way or the other to make things better or worse. So the big problem for investors with these slow growth stocks is slow growth businesses, I should say, is when earnings tip from being slowly going up to slowly going down, the stock doesn't slowly go down. The stock falls very quickly, usually. Because what happens is algorithms and investors, if you extrapolate 2% out long enough, you can justify kind of an investment sometimes. If you extrapolate negative 2% out long enough, then you're basically bankrupt. So once the extrapolation of future returns goes from positive to negative, that's when you see these big, huge declines, and that's when you can get like really hurt. So having that little cushion of at least 4% growth is what I do, and I have not regretted avoiding some of these slower growth stocks ever, basically. So that's pretty much it. You just aren't going to get, I have this is the expected 10-year return if nothing good or bad happens and we just get 2%. So the earnings, if you own the business, you're probably looking at like a 4.8% CAGR or something like that over 10 years. That's less than 5. That would be a sell if I owned it. So this would be an outright sell if I owned it. It would be an avoid if I was looking to buy it because of the slow growth, even if the price changed. So even if the price fell, I don't even have a buy price. Let's say the price fell 50%. That would be enough probably maybe to turn this to 8% threshold, which would be my normal buy price. I still wouldn't buy it because this earnings growth is too low. This trumps cheapness. And if they weren't doing M&A and we weren't coming out of that dip in 2020, probably this will be negative soon too, or it could be. That's a 3-year revenue growth, and that trumps everything too. So this is a sell, this is a avoid, and I think it's pretty simple. Just generally, I covered UTX for just a little while before the merger, and they were overvalued then. They didn't have hardly any growth then. I mean, the reason they merged is because they didn't have growth, in my opinion. And it doesn't really surprise me when companies are kind of struggling for growth that they cut corners and problems come. Oh, we should also look, usually things get worse before they get better. I mean, if we look at Boeing, so I don't know why anybody owns Boeing. I've been bearish on them before this, during all this. But look at how much money that they have lost over this last 5 years. They still are not making any money. I mean, let's just see here. So we have 27, let's call this $35 a share for those 3 years combined. They've lost 26, 35, 47, 50. So they've over the last 10 years they've made no money, basically. Now someday they'll dig themselves out of this hole, maybe years and years from now. So if I was going to get into this kind of stock for RTX, I would be looking, I'm long Lockheed Martin, and I would buy Airbus when the price gets to like my buy price. And so that's where I'd be leaning in this area. And I would avoid these guys. I would avoid Boeing. And that's going to be about it. If you'd like to check out the Cyclical Investors Club premium channel, I'll have a link or premium service. I'll have a link in the description. And I'll see you guys in the next video. Feel free to request any stock that's in the S&P 500, and I will make a video on it and share it as soon as I can. Later.